Hello, fellow Rebel Capitals. Hope you're well. So we have delinquencies skyrocketing, and it's not just with student loans. We're going to get into this right now and try to connect some dots. And at the end of this video, I'm actually going to give you some more inputs that I'm using to determine how well or how poorly the US economy is doing. Because as you guys know, right now, it's very difficult to, let's say, trust the data coming from the government. Now, with this one, with delinquencies, I think it's pretty straightforward because this is data that's coming from the private sector, from the banking systems, from the Fed. So I would, believe it or not, trust that a heck of a lot more than I would trust the BLS now and moving forward. Okay, on that note, let's dive into what's going on with the student loans, and we're going to get into the mortgages as well, and credit card debt. I believe the New York Fed just went into that. So we got the screen share going. Okay, student loan borrowers face default cliff as late payments climb. Now, it's not that just late payments climb. As far as I can tell, these delinquencies are at an all-time high. So let's read the key talking points. As the U.S. Department of Education ramps up collection efforts on past due federal student loans. And by the way, remember, all these things were on forbearance or whatever the word is. The bottom line is people didn't have to pay them. But the interest was accruing. It's not like they just got a get out of jail free card. That interest was accruing the entire time. So I assume that gets tacked on to the end, and that would increase their payment, all else being equal. And I remember the average student loan payment is about $400. So you say, oh, it's just $400. But hey, for the average Joe and Jane, I mean, that's a big deal. That's their discretionary income, most people, at the end of the month. So getting back to it here, the past due federal student loan, a default wave is coming. It's already come. I mean, I don't know what you're talking about. It's coming. It's already here. Of the 5.8 million newly delinquent borrowers, nearly 1/3 could reach default status in July, according to TransUnion. Student loan borrowers who are behind on their payments are also seeing their credit scores tumble. This is someone that very few people are talking about. And it's not just the the fact that delinquency rates are going up. The fact it's also about what that does to credit scores and what that does to people's ability, like first-time home buyers, to go out there and buy a house or to borrow money for a car. And even if they can get a car loan, what's the interest rate? Well, it's double what it would have been. And that means that aggregate demand goes down. So it's this daisy chain of reactions. It's the knock-on effects that we have to be cognizant of. Looks like Trump just nominated Stephen Moran. Stephen Moran, who is that? I don't want to get off topic. I'll have to research that, but my gut tells me it's someone I'm not going to like. What are the chances, huh? Is Stephen Moran, is he the guy that, I think he's the guy that wrote that paper. Josh, do me a favor and look up the paper he wrote. I know a bunch of people were citing it, and I think it was total nonsense. But anyway, while I'm going through that, look that up for me. When you find it, let me know, please. So by the new analysis by TransUnion. Now we're going to get to the Federal Reserve report that I was referring to earlier in just a moment. But this was TransUnion found that as of April, 31% of student loan borrowers with a payment due are in the late stage delinquency. Not exactly what you would expect in an economy that's booming, but it's exactly what you would expect in an economy that's adding, let's say, I don't know, 14,000, I don't know, 19,000 jobs a month. Wink, wink. And you guys know exactly what I'm talking about, right? The last non-farm payroll. The highest share the credit bureau has ever recorded. Okay. So now let's go over to the New York Fed. Whoa, that's not it. Okay, and this is from Reuters, excuse me, Reuters just came out the other day, August 5th. New York Fed flags rise in student loan borrowings, troubles in second quarter. Yeah, and this is looking back on the second quarter. It's not even looking forward what's going to happen in the third quarter. Chart is pretty much all you need to know right here. That says it all. You see this going completely parabolic to an all-time high? That's student loan payment delinquencies. Now, whoever designed this chart needs to be punched in the face, because why you would use basically the exact same color for every single line? Why? Why would you do that? There's a lot of different colors out there, my friend. We're not limited to various shades of orange. How about you throw in a blue? I don't know. How about you throw in a green? Something, mix it up here. But this one right here, this is student loan. You can tell from the from the legend up here. Student loan, boom, parabolic. Now, as you would expect, when Biden comes out and says that nobody has to pay, the delinquency rate goes straight down. Now, how it was even at 2%, I don't know. You didn't have to pay. But then it goes down, down, down. And then all of a sudden, just the other day, they have to start repaying. And quite frankly, you probably had 8, 9, 10 million people that forgot about it. Or they're like, I'm just not going to do it. They basically changed their spending habits to incorporate this additional money that they didn't have back in 2019, because that money was going out in the form of that student loan payment. But it's not just the student loans. And I know it's hard to see with this stupid chart because they didn't use any other colors other than a various shade of orange. But this line is HELOCs, I think, or it might be all. I think that is or maybe that's the all. But I don't know what the hell it is. The bottom line is every single category is higher than it was in 2019. And the student loan is higher than it ever has been, ever, ever, ever. So if we look at each one of these, 2019, we're right about here prior to the cerveza sickness. So with this line, it was here, now it's here, higher. This line, it was here, now it's here, higher. This line, both these lines, they were here, now they're up here. And you can see we just go down, although you can't really differentiate between what the lines actually, or you can't really decipher what the lines actually are, you can see that every single one of them is higher than it was in 2019. Okay, so now let's go back to, let's see some specific data. The Federal Reserve Bank of New York said on Tuesday, as part of its latest quarterly report on household debt and credit, that overall borrowing during the second quarter increased 185 billion, or 1% from the first quarter. Okay, great. Housing-related credit, which makes up the bulk of borrowing, ticked up. That's no surprise, but where are the delinquency rates? The report overall, types of debt, some types of delinquency was elevated during the second quarter. Okay, so this is just an overall, but do they have mortgage payments in? Yes, they do. Mortgage payments right there. That's the one we should really, really be paying attention to. But it looks like credit card delinquencies are way up as well. Now, not at, I think this is credit card. And that is not at an all-time high, but it is really close to where we were during the GFC. Really close. Or maybe not, because this is could you make a more confusing chart? All right, forget the GFC. We'll just say that it only applies to student loans, which is way higher now as far as the delinquencies. And we'll just go back to focusing on 2019 to today's date. All right, so the all category, I think that's what's up at 4.4. The move into trouble status was mixed across borrowing types, with delinquent mortgages and home credit lines up slightly from the first quarter. The student, and keep in mind, that's where all these people have equity. What happens when you get into markets where they're starting to see a lot of negative equity? And you may say that's not a thing. I saw a chart today, I think it was on Zero Hedge, that showed the top 5 areas where the majority of people have negative equity, and you're starting to see them pop up. They were all in Florida and Texas, by the way. Housing friction. The New York Fed report also delved into housing trends and found against a solid overall landscape where borrowing has been bound by strict credit standards. Really? I mean, come on. Strict credit standards? Strict credit standards are when you're requiring 20% down payment, 30% down payment, 40% down payment. Strict credit standards are not a function of 1% down or 5% down when your credit score, by the way, is artificially high because you haven't had to pay anything for the last 4 years. I mean, let's call a spade here. There are rising issues with loans from federal FHA, which helps existing first-time home buyers. Unfortunately, a lot of these first-time home buyers now have negative equity, we were saying before. Despite the recent tick up in mortgage delinquencies, overall mortgage performance remains strong by historical standards. Right, but you're looking in the rearview mirror. Now let's go ahead and look through the windshield. That's what we got to do here. We got to look at the trend. And that's the whole point of this video. When you look at that last chart and you see the trend, it shows us that we're not headed in the right direction. And if this continues, which it likely will, especially when you combine that with the data we were getting from the labor market, it shows you how this is really slowing down. And it makes sense, right? Aggregate demand is decreasing because prices have gone way, way, way up and incomes haven't kept pace. The only thing that bailed people out were the stimmies and not having to make a lot of these payments. And now that we go back to reality, where you actually have to pay your debts, we see that aggregate demand go down even further, which negatively impacts the economy, which negatively impacts the labor market. Getting back to this, but they cautioned that what's happening now may be a return to where we were a few years ago, in the way the current high flow delinquency rates are offsetting the artificially low delinquency rates during the cerveza sickness. Okay. Bottom line is we're higher now than we were in 2019 across the board. Housing related borrowing could face some headwinds. Yeah, we talked about that. Not only do people have less money, less purchasing power, you can argue that interest rates are high, but historically they're not. But I think a bigger story there is what happens to credit scores when a lot of people artificially had credit scores that were probably 100 points higher than they otherwise would have been. Are they even going to qualify? And then at what interest rate? And what does that do to demand for the housing market overall when demand right now is historically low? So they're saying we got a lot of credit card debt, a lot of auto related borrowing, and we're seeing that tick up as well. So this is a story we're really going to have to follow. And I think it takes us to what I wanted to mention here at the end of the video. In this world of government data being harder and harder and harder to sift through and figure out what is truth and what is propaganda, we have to look at real economy indicators, right? That can't really be manipulated. So as an example, we were talking about, or maybe I was talking about a whiteboard video. I've got a whiteboard video coming out tonight where I talk about this. But one thing that I like is this restaurant performance indicator. So we go over here, and this would be hard to fudge, let's say. So this is not a government agency that puts this out. So check. That's good. And we see that it's got a very consistent track record. And it makes a lot of sense because when you're in an economic slowdown, you would expect this to go down. When you're in a recession or an economic contraction, you would expect it to go below 100, which is basically negative. And you can see we're kind of right on teetering on the edge right now. But I would combine this with other things such as Airbnb. So Airbnb just reported numbers yesterday. They're pretty strong. So that's good news for the economy. But if I saw the restaurant performance index tank, in addition to that, if I saw these corporations that I think are heavily tied to the consumer and their purchasing power, their disposable income, like Airbnb, I would make note of that. I would also look at the airlines. I would look at, just anecdotally, the local malls, the bars, the movie theaters, and then I would really, really, really pay attention to oil, the price of oil. Let's go over that really quick here. CNBC. I'd look at copper as well. Whoops, not crypto. So, what am I doing here, George? Come on, buddy. All right, oil. There we go. So down quite a bit today. Again, I didn't even realize that. But if we look at a chart going back, let's say 5 years, way up here when Russia invaded Ukraine, and since that time, guys, it's pretty much straight down. I mean, as far as the trend, and it's not really supply side stuff, because OPEC plus has really been trying to limit supply to prop up the price. This is all about demand. This is all about demand, in my view. So when you're combining things like the price of oil that the government really can't manipulate, the restaurant performance index, the numbers that come out from the airlines, Airbnb, basically these corporations that are sensitive to consumer spending and maybe more specifically disposable income, I think you're going to get a much, much better view as to how the real economy is performing underneath the hood than, unfortunately, just looking at the labor market statistics coming from the government on a move forward basis. Because I don't know that you can, I don't know that you couldn't really trust them in the past, but I think it's going to be even worse moving forward. Even, it's not a Donald Trump thing. Even if he puts someone in there that's a straight shooter, that is very sound morally and ethically, they're going to have an incentive to, let's say, spit shine the numbers, because they know if they come out with numbers that aren't that great, then they could be on the chopping block and they could potentially lose their job. It's just incentives. It is what it is. So what I'm going to do for my own portfolio, and what I'm going to start talking about on this channel, I'm going to start talking about these real world indicators, and going back to things like the yield curve as well, and interest rates, that it's much harder for the government to manipulate, and trying to come to conclusions, not strictly based on that, but I'm going to, let's say, reprioritize them. And by the way, one of those things is going to be delinquencies like mortgages, auto loans, student loan payments, and credit cards, which is what this video is all about. All right, guys, enjoy the rest of your afternoon. As always, make sure you're standing up for freedom, liberty, free market capitalism. We'll see you in the next video.